What's up, everybody, and welcome to episode 10. I am Brian Graham. Today, we're going to talk about understanding real estate market cycles. So, real estate market cycles, you'll find a ton of different definitions for them on the internet and the time frames at which they occur. But if you're doing research and trying to time the market and doing research on what is a real estate market cycle, you may find tons of different information. You have to figure out what is the definition you're going to use. So the definition that we're going to use today of a real estate market cycle is when four things occur. Those four things are recovery, expansion, hypersupply, and a recession. So those four things create a cycle because then it restarts. So let's talk about each individual topic. The current market, let me backtrack. So let's talk about each individual topic. So we have a recovery, a real estate recovery. What does that mean? So real estate recovery would be the real estate market has just crashed. So let's go back to 2007, 2008, when bad loans were given out and there was tons of people that couldn't meet the demands of the loan, the terms of the loans, and then there's tons of property foreclosed on. So then it becomes an increased amount of homes on the market. People get their homes foreclosed on, and then the market crashes. The prices of values go home. The prices of homes go down. So there needs to be a recovery from that. People end up going back to the mortgage industry. The mortgage industry has now tightened up all of their loan terms. They're no longer giving out bad loans, and now you can get a mortgage. So then the housing market starts to recover. Homes are then purchased, the foreclosed homes, whatever type of home, the homes are purchased off the market, and then those people are then able to make their payments. So then we go into the second phase, which would be an expansion. So an expansion would refer to the supply and demand. So supply and demand, obviously, as the supply is low, the demand is high, prices increase. As the supply is high, the demand is low, the prices decrease. So then we go into expansion, where builders, investors, whoever, start to build homes, and then there becomes a number three, hypersupply, and homes are being built. Now there's an overemphasis on or oversupply of homes that are out there on the market. The demand, which meets the demand or exceeds the demand, and then the homes would then decrease in value, because now instead of 10 buyers for every house, there might be one buyer for every house, or 0.5 buyers for every house. And then we end up into a recession where the home prices drastically decrease or plummet. So where are we right now in the cycle? That's the question. How do I time it? Where are we? Well, we need to understand that supply and demand. We also need to talk about, is the housing market, does that refer to the interest rates? Does it refer to the prices of homes? Like, what does it refer to in terms of how to time the market? Are we in a recession? Are we not? So right now, some sources will say that there is a shortage of homes in the number ballpark of 3 to 4 million homes. There is a shortage. That means there's 3 to 4 million people out there that are demanding homes that can't get in them. It's a big number. That's 1% of the population. That means that if you build a home, chances are you're going to be able to find someone to buy it for you or rent it from you, because there's a massive shortage of homes. Because of that extreme demand, prices stay high. So if COVID was any indication of any part of the cycle, let's figure out what part it was. Was it a recovery, expansion, hypersupply, or was it a recession? So during COVID, prices skyrocket. There's a ton of money being printed. People are buying homes for whatever price, $20,000, $30,000, $40,000 over asking price. No closing cost assistance, no inspection contingencies, no nothing. So I would call that a recovery and expansion. So the economy, the stock market plummeted in COVID because there's fear. People pull money out of their stocks. But the housing market didn't crash. 2 or 3 months after COVID was like officially announced and the world pretty much shut down, 2 or 3 months after the world starts to come back, people start to move. They got stir crazy. Then they start to change homes. It starts to move around. They refinance their homes. So there was a recovery from that very quickly, and then an expansion where people are moving, their homes being built. But here we are in 2024, 4 years after COVID now, and we've experienced a housing market stall where there's not 10 offers for every home. There may be 2 or 3. The demand is still there, and there's still a 3 to 4 million home shortage. So we still have not even entered the hypersupply yet. People say we were in a recession, but let's put the rest of the economy aside. Where are we in the real estate market cycle? Technically, we never hit that recession. Interest rates came up, which slows down the buying process because on a $800,000 home at a 6% interest rate, you're looking at a payment of $4,800 a month. At a 2% interest rate, you were looking at a payment of, whatever the math is, $2,000 a month. So it's a significant change in the potential buyer you can have. Now you need someone who makes an average of $125,000 a year, as opposed to someone who used to make an average of $75,000 a year on that $800,000 home. So did that send us into a recession? My answer is no, it did not. Because the recession, in my opinion, would completely stall the real estate market. And it hasn't. It slowed down the buying process, but the demand is still there. There is no oversupply or hypersupply. So if we've never hit the hypersupply, we can't hit the recession. So what happens in the future? When is the housing market coming down? That's a good question. What it comes down to is the supply and demand. As population increases, can we meet the demand for homes? If we are on a downward trajectory with population, eventually that will catch up to us, and then there'll be more homes than people are. And so therefore, then home prices are forced to come down. So that would be really the only thing that could happen to slow it down. Otherwise, interest rates would have to increase 2, 3, 4 or more percent in order to completely stall the market. Now, that doesn't mean that home prices come down. That may just mean homes stop being bought. Because if I can afford an $800,000 house at a 6% interest rate, 7% interest rate, but that home goes up to 9%, I'll just stay where I'm at. Or that home would have to, if that seller needs to sell, they may decrease the price to the equivalent payment, which would be somewhere between, not even equivalent payment, maybe just slightly above, somewhere between like a $650,000 to $700,000 house. So you may lose 50 to 100 grand on that $800,000 house. That's not even 20% of the home value, which in the scheme of real estate is not a crash by any means. When you're talking crash, if you look back to 2007, 2008, there's homes that were $500,000, $600,000, $700,000 that dropped down to 200. Now that would be a crash, losing 70% value. There's been nothing but an upward trajectory since that 2008, 2007 timeframe. And I cannot think of a reason why in the short term, 2, 3, 4 years, why the housing market, in terms of appreciation value, in terms of the value of the home, why it would come down. I can't figure it out. Why would it? It doesn't make sense. It doesn't economically make sense of why the home prices would come down if the interest rates continue to stay where they're at. The interest rate is what it is because of inflation. When you print money, there's an oversupply of money. talk about a supply and demand of money. There's more than enough money to go around, so people spend it because you're printing more and giving it away. So then the cost of living, the cost of goods goes up because you're spending more. So the current real estate market cycle, in terms of buying homes, does it make sense? Does it make sense for you as a homeowner, or does it make sense for you as an investor? That's a decision that you would have to figure out based on the numbers and the type of home. So these definitions really talk about the value of real estate. Now, personally, am I going to buy a home for $100,000 when I can only rent for $900? No, because at a $100,000 home at an 8% interest rate, let's use 7%. My monthly payment of $700, if that home rents for $900, after expenses, I break even on that property. I break even on cash flow. I don't make any money. And so is that a good investment for me? Not really. Not really. So if the housing market crashes, like let's say I buy that $100,000 home and the housing market crashed, and my home's now worth $50,000. If that home can continue to rent for $900, but now that interest rate, sorry, let me backtrack. If that home is worth $100,000, I choose not to buy. But then the housing market crashes down to 50. But I had the same amount of cash available to me. If the housing market crashes to promote economic purchase, interest rates are forced to come down to promote people spending money, to incentivize you to spend money. So that house comes down in price, let's say to $50,000, which is a crazy crash, but it's possible. If I have $20,000 to put down on that $100,000 home, I can now buy two $50,000 homes. The interest rates are forced to come down, which means my cash flow is going to be higher. That home should still rent for $900. Here's what doesn't happen in a market crash. The home drops from 100 to 500,000 or 100,000 to 50,000, but the rent does not drop from 900 to 450. That's not how it works, because at the end of the day, the job and the amount of money that single renter is making is still the same. And so the rent may continuously, slowly come down, but you won't see the rent get cut in half, similar to the value of the home, which makes buying cash flow properties a much greater, even greater incentive, an even greater opportunity. I highly recommend that when you are researching what a real estate market cycle is and when to invest, you spend less time trying to focus on how to time the market and more time trying to focus on, will that property still cash flow even if there is a housing market crash? What is drawing someone to that market? Is it jobs? Is it a suburban or rural area that is just outside a city that has jobs? If there is no hyper supply after the recovery and expansion of real estate, there can be no recession. It doesn't make logical sense. That is what supply and demand is. If there is 5 homes out there, but 100 buyers, you're going to have 20 offers on each home. But if that scenario stays the same across the board, that those 100 buyers will still be there. Only in the case if there's 150 homes with 100 buyers will those prices come down, because those sellers will be competing against one another to try and sell their home to a smaller pool of buyers. Right now, every single market that you invest in, it is possible that there is an individual real estate market cycle amongst that particular market. And that is what part of doing your due diligence is about where to invest. For example, there was a Rolls-Royce manufacturing plant located in Central Ohio. That, I assume, brought many jobs. Well, that Rolls-Royce manufacturing plant closed down. I don't know if that plant has a new business in it, but the home prices started to slow down in terms of raising appreciation value. The home prices started to halt. There were more homes than listed on the market when that Rolls-Royce plant left, when that Rolls-Royce plant moved or left or ceased to exist. I don't know what happened to it. I just know it's not there anymore. The amount of homes that came on the market was higher because people noticed that information. People noticed like, oh, there was something drawing people here or keeping people here, and now it's gone. I need to get rid of my property because I'm afraid that it won't be rented. A lot of people will stay where they are and rent your homes and live there and purchase them. But if there's, again, a hyper supply of homes on the market, now this Rolls-Royce plant moves and 100 homes go on the market. Well, because it's a suburban town or rural town, there may have only been 20 buyers. Now there's 100 homes. Boom, everyone wanted to get out, but the prices decrease now because there's not as many buyers. The demand isn't there. But before, there could have been 5 homes on the market and 5 buyers or 20 buyers. Then everyone wants to buy. 4 offers per home. They're competing for, no closing cost help, no incentives, no inspection contingencies, no nothing. So that individual market had a little bit of a recession and cycle, and it's difficult to look at the country as a whole and say, hey, real estate's doing great or real estate's doing bad, when each market has its own real estate cycle based on how businesses are coming and going and creating jobs or not. Another example, in northern Ohio, east of Columbus, I believe it's Intel that just purchased a multi-billion-dollar piece of land, and they're building a multi-billion-dollar facility for the chip manufacturing. That's going to bring tons of jobs. I think it's upwards of 10,000 jobs. Do you think it's a good idea to buy real estate in that area? Of course. So in that particular region, is there recovery? Is there expansion? Is there a hyper supply? There is not. There's not a hyper supply. That's 10,000, possibly 10,000 new people showing up to a location where there's going to be 10,000 new jobs, and they're going to need homes. Are they going to rent? Are they going to buy? If you build a home that's near the manufacturing plant, why would they not buy it? It's an easy commute to their job. So look at that particular market that you're interested in investing in and ask yourself, where is this market in its current cycle? Because what happens in LA does not affect what happens in Ohio. What happens in southern Mississippi is not the same thing that's going on in northern Dakota, because they're completely different areas. When the housing market crashed, do you think there was a ton of people that lost money? Of course. But there's also a ton of people that made money, because how someone views the market, how someone views the cycle can be very different. So do your research on how you want to define what a real estate market cycle is, and do your research on the market that you want to invest in and figure out where that particular market is in its own cycle. I hope this podcast episode was of interest and of help. I wish you guys the best of luck, and I will see you next week for episode 11. Again, I am Brian Graham, and thanks for watching. The advice and recommendations I offer are intended to be informative and educational, drawing from my own experiences in the real estate market. It is crucial to recognize that every investment decision carries risk and outcomes may vary. I am not a financial advisor, and the information provided during these podcast episodes is not intended as financial, legal, or professional advice. It is your responsibility to conduct thorough due diligence, seek the advice of qualified financial professionals, and make informed decisions based on your individual financial situation and goals.